And the reason why it's good to understand how basis operates is it can affect your trading in any number of ways. It can mean the difference between you eking out another 5% profit or you losing everything. Because futures operates not in a vacuum, but with the cash market, it's great to understand why the cash is operating that way, and if you can have a potential profit when cash and futures either cross, converge, or diverge, and where that profit is to be found. And we're going to go over a few examples to really clearly indicate what cash, futures, and basis actually means. Now, in our first example, we have a short hedge in T-bonds. T-bonds are treasury bonds, and we're looking at a very basic scenario of an ideal hedge for a company. There's the cash market and the futures market. They buy the cash bonds, maybe anticipating in the future they're going to sell them at a higher rate or whatever the case may be, but they buy the cash bonds at 105.07. Now, although futures is directed by the cash market, they don't move in lockstep in pricing, even in the spot months. So in this futures market scenario, we see that when they bought the cash bond, they decided to hedge in the futures by shorting. As I said before, shorts get preferential treatment, and they hedged at 105.17. Now, the difference between the 105.07 and the 105.17 is about 10 points, and that's the basis for the difference between the cash and the futures. Now, later on, they decide to sell their cash bonds, and they sell them at a loss of 104.18 with a loss of 21 points. They then buy back their futures position, and they end up with a gain of 29 points. Now, the difference between the loss that they had of 21 points and the gain they had of 29 points creates their profit of the net gain of 8 points, and that is the basis profit in the scenario. So that although the cash wasn't profitable for them, the difference between the cash and the futures and how the basis operated by actually narrowing where the cash and the futures start to meet closer and closer to price created a profit for them above and beyond what they expected. So they ended up with an 8-point profit. So the narrowing of a basis is profitable for a long cash hedger. Now remember, even though we're talking about futures, we can't separate futures from the cash market at all. They're together. And so there's opportunities, even when you're trading futures, to trade this basis difference, not only with the cash market, but for instance with the spot month and the following month in creating spread opportunities in trading futures. And let's go through a couple more examples of basis to really drive home the point. Next, we have a short hedge in T-bond futures. And again, it's the same scenario, but with a slight difference. We have the institutional investor buying cash at 105.07, selling in the futures market at 105.17. So we again have the basis of 10. Then we see them selling cash at 104.18 and then buying the futures back at 104.31. Well, the loss is 21 cents on one side and the gain is 18 cents on the other. And we look at it, we have a net basis loss of 3. Well, when they lost capital, or where they lost capital, was not necessarily in doing the short. They lost capital in the fact that the futures was not moving down as quickly as the cash market. So this could represent any number of things, that maybe the following month is going to be stronger, maybe there's a turnaround coming. And so when you see that the basis, in this instance, began to widen and cash was not in lockstep with futures, various things can be happening. It's definitely momentum plays, accumulation is happening here. And in section B, we really go more in depth on looking at the tools to determine what accumulation looks like, distribution looks like, as well as what overbought and oversold may happens. And so we see a widening basis here, and it's not profitable for the long cash hedger, and it hurts their bottom line. And these are the things that as speculators we have to consider that our competition, which is the hedgers, are actually thinking of and are watching in the marketplace. Here's an example of decreasing basis in a long hedge scenario. And in a long hedge scenario, it is simply inverted. These are the buyers, the sellers in the marketplace, and they're doing a short cash hedge. So they intend to sell the cash bonds now and buy them back later in the cash marketplace. So they sell the cash bonds at 105.07. They buy the cash bonds back at 104.22, and they have a profit of 17. To protect their position so that the futures doesn't go against them, they go long in the futures market at 105.17, and then they sell the T-bond futures at 104.31. And it looks as if they had a great opportunity. They profited in the cash market, and unfortunately they lost in the futures market. And because the basis began to narrow for this person who was doing a short cash hedge, they actually lost money on this trade. And these are things that you have to keep in mind, that not every opportunity that you do in transacting the cash market versus the futures market or putting on spread opportunities will work out exactly the way you want them. So you have to be careful of what momentum is happening where and really understand what markets have the liquidity, the volatility necessary. In this instance, the cash market lost. Now, what basis risk means? Hedgers accept that basis risk exists. They know going into it that the difference between the cash price and the futures price are there. And so they're leaving money on the table constantly. You got to remember, for them it's just a cost of doing business. And so there's profits there for the speculators to exploit. Now, part of understanding basis is actually the convergence of futures and the cash price, and this falls back into our notice day scenario, our last trading day, our first notice day, and our last notice day, as well as just when you're starting to come near the end of a futures contract prior to any of that happening. Since only 3% of the hedgers take or make delivery on the contracts, there are opportunities when the price between the futures and the cash converge. And as we saw, when it narrows and you're short or long, depending, as it narrows, there's profits for you to be made. Now, here's the breakdown of the convergence, and there's two different types of markets. There's normal markets, and inverted markets. And in a convergence of cash and futures in a normal market, we see that if you're a short hedge during a normal market, you've got preferential treatment. When futures are down, you actually gain because you're short the futures. And when cash is up, you gain because you're long the cash. And so as these two begin to meet towards the middle, you begin to profit on both sides. And so short hedgers actually have convergence gains during normal markets. A lot of profit there. So futures actually tend to favor those people who are short solely by the fact that normal markets create profit for short cash hedgers. And it's good to understand that fundamental analysis because it goes opposite what most stock investors are used to. Buy. In futures, you're better off oftentimes selling. In this scenario, in a normal market, being long in futures is not great for you. When futures are down, you're losing money because you're long. And the cash is up when you were short the cash, and it's a loss. So it's double loss on both sides. So futures really don't favor those people who have a tendency to continually want to buy into the marketplace. Shorts have definitely got an edge. But that's during normal markets. Not all markets happen normally. So during inverted markets, we see that futures operates completely on its head. Those people who are short during inverted markets tend to be those people who are short during inverted markets tend to be losers. The cash is down. When they were long cash, they made losses. The futures are up, so they made losses, and the short hedgers just don't have any chance of profiting in this marketplace. And so it's very good to know the fundamentals of what's happening here and where you can profit.